Welcome to 3 and 3. Today we're going to be talking about the Federal Reserve mandates, rate cut expectations, and rate cut beneficiaries. So the Federal Reserve mandate for monetary policy is commonly known as the dual mandate. The dual mandate consists of promoting maximum employment. So the unemployment rate is considered to be at maximum sustainable level when it's in between 4 and 5%. Stable prices. So stable prices, the Fed's target inflation is typically around 2%. And the primary tool the Fed uses to achieve these mandates is through controlling interest rates, the overnight or discount window. And you can see from this chart going back to 2004 and looking at the unemployment rate and comparing that to the CPI index. And currently, what we're seeing is that the Fed actually has a difficult task at hand because we are not at the 2% targeted rate, and employment is actually at pretty much full employment. So we'll see what rate expectations look like going in the forward, but that's where these projections around inflation and employment into the future may actually start changing the forecast. So rate cut expectations. The consumer price index dropped 0.1% in June, while economists actually expected a rise. Many institutions now have pulled forward expectations of an interest rate cut at the actual now September meeting due to this actually drop in inflation in June. And as of 7/19, the CME FedWatch tool actually shows a 98.1% probability of a Fed cut. If you're looking at these expectations from firms of rate cuts before June CPI print, you can see that Goldman Sachs had 2 rate cuts, B of A had 1 rate cut, JP Morgan had 1 rate cut, and Barclays had 1, and Morgan Stanley had 3. But now after that print, we're starting to see more firms jump on the bandwagon of more rate cuts. Deutsche is now at 3 rate cuts. You're also seeing Barclays at 2. So we'll see what actually happens, but the Fed target rate now has actually come down, which could help particularly certain areas of the stock market and the economy. So with these rate cuts, there are beneficiaries. Lower rates can actually benefit sectors and investments. So growth stocks, lower rates can increase the value of future earnings and reduce borrowing costs for growth companies, which can cause growth stocks to actually increase in value. And small and mid-cap stocks, this is an area of the market that's been avoided now for almost about 3 years. So a lower rate tends to benefit smaller companies, which generally have higher levels of debt than bigger ones and can be more susceptible to economic stress. And again, real estate, right? Real estate investment trusts and other real estate investments can benefit from falling interest rates. What you're looking at here is a chart showing the small cap index, the real estate index versus the actual S&P. And the S&P is that yellow line. And then you're also looking at the total return for the real estate index is that blue line. And the purple is actually then the small cap index. And since that CPI print, you can see that small caps have outperformed and also the real estate index has outperformed, whereas the S&P has actually trended somewhat flat since then. Thank you for joining us for 3 and 3.